All right, let's get right into it. Deep inside the rulebook for the COMEX, that's the world's biggest metals exchange, there's a clause that most people, even traders, just skim right over until it's way too late. It's called force majeure, and if you think it's just some standard legal boilerplate, well, you might be in for a rude awakening about the risks that are building up in the precious metals market as we speak.
The name itself sounds kind of fancy, right? Force majeure. It's French for superior force, and we usually think of it in terms of things nobody can control. Acts of God, massive floods, a war breaking out. These are the things that let people get out of contracts without getting penalized. But, and this is the important part, that's not the whole story here.
You see, in the world of COMEX gold and silver, this clause means something very, very different. It's basically a hidden escape hatch. It means the exchange can just straight up refuse to give you the physical metal you're owed, even when your contract says you're guaranteed to get it. Instead, they can just settle with you in cash. So, the big question is, how is that even possible?
So in this explainer, we're going to pull back the curtain on all of it. We're going to look at this hidden clause, we'll talk about why the system is really just built on paper, we'll go over the triggers and the warning signs you need to look out for, what happens the day it all breaks, and, most importantly, a financial playbook for how you can prepare for this kind of risk. Okay, so let's get right to the core of it. Why does this escape hatch even need to exist in the first place? Well, the answer is in the DNA of the COMEX market itself. It's a system that was built right from the very beginning on paper.
The whole thing works on what's essentially a fractional reserve system, but for precious metals. All that means is that the amount of paper, gold, and silver contracts being traded back and forth absolutely, massively dwarfs the actual physical metal they have stored in their vaults.
And these ratios can get, well, pretty insane. We're talking 100 to 1, maybe even as high as 500 to 1 on some days. Think about that. For every single ounce of real physical gold sitting in a vault, there could be hundreds of paper claims all saying they own it. It's like a high-stakes game of musical chairs, where everyone is just hoping the music never, ever stops.
And this visual right here just says it all. I mean, look at that giant bar for paper claims next to that tiny little sliver of actual physical inventory. The force majeure clause exists for one reason. The people who built this system know that the math falls apart if everyone actually asks for their metal at the same time. They literally built the emergency exit in from the start.
Now, if you actually go read the rulebook, it starts off with specific stuff. Wars, strikes, floods. But then you get to the end, and it gets real vague real fast. Any other cause. I mean, come on, that's a loophole big enough to drive a fleet of Brinks trucks through. And it's there to give them maximum wiggle room when things get messy.
So let's be crystal clear about who this clause is really for. It's not for you, the investor. It's there to protect the big bullion banks, the major players who are often massively short on paper metals. When they've sold promises for way more metal than they can ever deliver, this force majeure clause becomes their get-out-of-jail-free card.
All right, so now that we know the problem is baked into the system, let's move on. How do you actually see a crisis like this coming? What are the triggers? What are the warning signs that would tell us the COMEX might be about to hit that big red button and declare force majeure?
You can really boil it down to three main scenarios. You could have a huge supply disruption, but that's something the market would probably see coming from a mile away. The really dangerous ones are a coordinated delivery squeeze, where someone with deep pockets tries to call their bluff, or a major currency crisis, where everyone suddenly loses faith in paper money and makes a mad dash for hard assets.
The good news is, you don't have to guess. You can actually build a sort of dashboard of key indicators that will start flashing red when the physical delivery system is under serious pressure. Let's walk through the 5 biggest red flags.
First, you have to watch the COMEX warehouse stock reports. Eligible metal is just gold or silver sitting in the vault, but registered metal is what's been officially marked as available to deliver on a contract. When you see those registered stocks start to drop fast while the eligible metal just sits there, that's a huge warning sign. It means the owners of that metal don't want to sell it at today's prices. Second is a weird-sounding condition called backwardation. Normally, it costs more to buy gold for delivery next month than for delivery today. But when the market flips, when it's suddenly cheaper to get gold in the future than it is right now, that's a sign of panic. It's the market screaming for immediate physical metal, and it's a massive red flag.
Third, watch what the traders themselves are doing. Most of the time, they just roll their contracts forward. They don't actually want the metal. But when you start to see a spike in the number of traders who are standing for delivery, meaning they are demanding the physical bars, that's someone putting the system to the test.
Number 4 is about what's happening in the real world.
You know, the price you pay for a physical gold coin over the paper's spot price. Normally, that premium might be $50, maybe $100. But when it explodes to $200, $300, even $500 or more, the market is telling you that the paper price has become a fantasy.
And finally, number 5. Watch the insiders. The reports from the CFTC lump the big bullion banks into a category called commercial traders. If you see them suddenly and drastically cutting back their short positions, especially while prices are going up, that's a pretty good sign that the people who know the system best are getting nervous.
So let's just imagine for a second that all those red flags start flashing and the COMEX pulls the trigger. What happens on the day after it breaks? Well, what you get is pure chaos, and this massive, unbridgeable chasm opens up in the market.
The very first thing that happens is that your contract to get physical metal is just canceled. They force you to settle in cash, but here's the kicker. You don't get the price that the market is screaming for. You get a price that a committee at the exchange decides on, and you can bet that price is going to be in their best interest, not yours.
And this is what happens next. A two-tier market forms instantly. The COMEX might settle your paper contract at, say, $2,800 an ounce. But out in the real world, the price to actually get your hands on a physical ounce of gold could be trading for $4,200, if you can even find any to buy. The paper price becomes totally meaningless.
Look, I know this all sounds pretty intense, but understanding the risk is always the first step. So let's pivot to what really matters. What can you actually do? What's the playbook for getting ready for this kind of systemic risk?
There are really 4 key things to think about. First and most obvious, own the physical metal yourself. If it's in your possession, a COMEX default is just a headline. Second, if you do trade futures, just don't hold them into the delivery month. Roll them early and avoid the drama. Third, don't put all your eggs in one basket. Diversify where you store your metal, preferably in non-COMEX vaults in different countries. And fourth, read the fine print on everything, especially paper assets like ETFs, because they have their own escape clauses too.
And if you think this is all just some wild theory, remember, history is littered with examples of the people in charge changing the rules when it suits them. FDR confiscating gold in '33, Nixon slamming the gold window shut in '71, even the COMEX changing its own rules to stop the Hunt brothers silver squeeze in 1980. When the system itself is on the line, promises get broken. So it all really boils down to this one final question you have to ask yourself. When the crisis hits and that game of musical chairs finally stops, what do you want to be holding? A paper promise that can be cashed out at a price someone else decides, or the actual physical metal itself? How you answer that question should probably shape your entire strategy.